Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be talking about attempting to speed up the process of generating income. There are some traders that are drawn to selling very short-term options contracts. So we're going to be talking about selling put options in 10 days or less. We're going to be weighing the pros and the cons. There are pros, there are cons. We need to be aware of each of those. Before we can get to any of that discussion, I first of all want to say hello to everybody who's joining us out in YouTube. Hello there, Will and Alfred, Marcus, Miss Street Fortune, Doug, Eva, everybody else. Thanks for joining us week after week. We really appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. Be aware that you're invited to join us in a live discussion. This is a Monday webcast series, and we kick things off promptly at 2 Eastern Time. We would love to have you here in the live audience. And also, for our live audience members, we have a special treat. We have Barb Armstrong hanging out in chats with us. Barb's going to be addressing any questions that I can't get to just during the flow of the presentation. Barb's a fabulous presenter and coach. Great resource to have here. Thanks for having my back there, Barb. And Barb and I would also like to issue an invitation to everyone, live audience, or those just watching on the recordings. If you're not following us on X, and if you have an account with X, give us a follow there. It's the best place to connect with your favorite presenters in between the live streams. And you can find Barb there. She's very active on X at Barb Armstrong CS. You can also find me there at Cameron May CS. But let's get into this discussion of selling put options in 10 days or less. Okay, as we do it, of course, we need to first pause to consider the risks associated with trading. This is important information. Bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so here's what we're going to be covering today. Yes, we're going to dedicate the bulk of our discussion to this weighing of the pursuit of income at a faster clip. So yeah, we're going to spend some good time with that. First thing that we're going to do, though, is have a quick peek at our example paper money trades in our example portfolio. I think that one or two of those need some attention. So we're going to go through all 6 and maybe make a change to 1 or 2. Then we're going to look at the S&P 500, see what's going on with stocks to set some sort of context for a background for this discussion. And then we'll get to selling puts at a faster clip, selling within 10 days. All right, so let's go right to it. Let's go to the Thinkorswim desktop trading software platform. And here are our covered calls and short puts positions from Apple right on down to XOM. Apple is misbehaving to some extent. I'm going to leave this one for last. Okay, so let's look at the other ones first. Let's have a first look at AbbVie. We have a covered call here. Bought 100 shares, sold a 210 call. We'd prefer for the stock to be below 210 if the trader is trying to avoid assignment. That's where they have the strongest likelihood of not being assigned. Stock's actually trading at 215. Doesn't mean that this is an unprofitable trade. As a matter of fact, you can see right now we're sitting at about a $2,100 profit. I think this caps out at about $2,300, the most that we could make on this position. So it's actually going very well. But just to revisit this trade, we bought our 100 shares back here at $190.71, waited for price to rise to a potential price ceiling. It looked like we might be seeing one here at around 205. So we sold a 210 call on, what date was that? The 24th of February. But price continued going higher. It's pushed up through our call. We're trading now above that call around 215. You can see that over here. Now, when a call goes in the money, especially if it's close to expiration, it does elevate the risk of early assignment. In this case, what that would mean, if the other party in this covered call transaction decided to exercise their right and assign the contract, they'd be buying our shares for 210 that we purchased for around 190. That would be nearly a $10 profit. It's actually about $9.29 that would be realized on the stock if we were assigned. And that would be in addition to the premium that we already collected on the call. So this trade's actually doing just fine. Our break-even's all the way down here below our entry price because of the premium that was collected. Our break-even's down at 188.47. So some distance, some buffer protecting us from real loss being incurred on this trade net. So with this one, I think I'll just leave this alone. Most likely scenario, if we don't do anything about this, is we wind up getting assigned. If the stock is still above 210, that's going to be the outcome with very rare exceptions. Sell the shares for 210. Okay, that's all right. What about IBM? Another covered call. We sold the 21st of March 265 calls. So we bought the stock for 249.05. It's trading above that, so stock is doing well. We sold the 265 calls. Those have actually retreated in value, so those are making money. So right now we're up about $600 if we want to see that on a chart. Here's what's going on with IBM. Bought the shares here. Shares are now worth this much. So we've worked our way up a little bit net. Sold the 21st of March 265 calls. Those are only worth about, what, 40 cents at this point? 42 cents? A trader might consider buying out of these calls at this point. That would remove that upside cap on the stock. I'm not going to do this today to give us more to talk about next week, but remaining in this means that we have still an obligation. If the other trader gets that wild hair, if they want to buy the shares for 265, they can do it. They're just not terribly likely to do that when the shares are trading at 253. But even out of the money contracts can still be assigned. So that IBM trade doing just fine. NEE is a position we took a couple of weeks ago. So now this is a short put. Let me go back here for just a moment. Sold, actually it wasn't a couple of weeks ago, this was last week's trade. Sold 2 contracts at the 72.5 strike. In this case, the trader would typically prefer that we remain above 72.5. It's a bullish trade. We're actually pretty close to that. We've slipped below that. So let's see what's going on with NEE. So here was the logic of the trade. Looked like we had just broken out to the upside, a strong up day, heavy volume on that day. So maybe the trader's thinking we're going to stay above about that 73 level. So we sold the 72.5 puts, and we actually have fallen down below that. You can see where we're trading right now, just a little bit below 72.5. That does elevate the risk of early assignment. Still a number of days till that April 18th expiration. We could be assigned. It's not terribly likely at this point. We'll see. We just have to be aware that could happen. But I'm going to let this one continue to work. With Wells Fargo, this is another covered call, 72.5 strike. So we'd like to probably stay below 72.5. We're closer to 71 right now. This is pretty much a break-even trade. We've made a little bit on our stock. We've lost a little bit on our option, unrealized gains and losses there. So pretty much a wash. What would be best for this trade? Well, we put ourselves in the shoes of a trader who owned the shares at 70 bucks. We sold the $80 calls up here, and the stock has really fallen all the way back down below to just above our assumed purchase price of 70 bucks. Those $80 calls are probably worth, oh, and sorry, we actually rolled this down. So this isn't a break-even trade because we were able to close out the 80 calls at a decent profit. We closed those out and sold some 72.5 calls right here. So overall, that trade's also doing all right. Now, finally, we have Exxon, not finally, because we'll also look at Apple, but for the trades that I'm not really going to be making any changes to, we'll say finally, with ExxonMobil, bought 100 shares, sold the 115 calls. You can see that our strike is just below 115, which is really optimal for that trader who wants to get the most out of the short call while not getting assigned on the contract. It's out of the money. Even an out of money could be assigned, but yeah, you can see here was the logic of our trade. Bought the shares down here at 106.92. Sold a call as it looked like we were approaching resistance there, and that resistance held all the way through until today. We've broken up through there, so the stock is moving toward our strike. It only has a couple of days left, a few days left. I think there are 4 days till expiration. It's Monday. Yep, these expire on Friday. So assignment risk starting to move higher. But even if we were assigned and the shares were sold at 115, well, we bought those at around 107. That would be an $8.08 realized gain if we were assigned on the stock, plus we keep the premium on the call. That would be a good closeout to that trade. This one, doing great. I'm going to leave that one alone. So let's give some attention to the one that is misbehaving, and that is this Apple put, 235 put. If I click on the quantity, you can see we sold this just a couple of weeks ago. It's March 17th right now. We sold these on March 3rd. This is a bullish trade. Typically, we prefer for the stock to go up and hopefully stay above 235, unless the trader's looking to purchase shares through the sale of a put. That's something we discussed last week, if we're initiating something like the wheel strategy. But what's going on with Apple? Not good things for bullish trades. So we took our trade up here, sold the 235 put, so someone has the right to sell shares to us for 235, and the stock has fallen well below the break-even point, which is 232. We collected a $3 premium on this 235 put, putting our break-even at 232. The stock has really fallen down. Now, expiration isn't for 4 days. There is no risk of early assignment in a paper money account because early assignment is not a thing on fake contracts. But in real life, there would certainly be an elevated risk of early assignment. Mike says, what probability out of the money are we selling? So Mike, I don't have a prescribed, let's say like a delta. You know, for some traders, they might use a specific delta to plan their contracts to sell, like a 20 delta if they want a high probability trade, or a 30 delta if they're looking for a little bit higher reward but a little bit lower probability, and so on. But we typically talk through different strikes that might be chosen because there are pros and cons to each. There is no prescribed best. I get that question all the time. Which one is the best delta? What's the best combination of probability versus reward? That's up to the individual trader, their confidence for the trade, the amount of risk, the appetite they have. All of those things play into making that decision. Okay, but let's decide what to do with this put. Because right now, we are staring straight into the face of likely assignment, meaning someone is likely to sell us shares at 235 unless we take some action. Now, is that always a bad thing? If we get put those shares at 235, those shares are only worth about 214 bucks. So we're overpaying for the shares by $21. We have $3 that we collected on our put, so that sort of compensates a little bit for that unrealized loss that we'd have on the stock. We'd be sitting on a $21 unrealized loss, assuming the shares are worth $214 at the time of assignment, versus a $3 gain on the put. That still leaves us $18 in the hole. Guess what? Sometimes that trade goes south on us. Yep. So the question, one question a trader might be asking themselves at this point is, well, do I want the shares? Because loss is, there's nothing we can do at this point to avoid that loss. Nope, the markets put us where we are. Only the markets can take us out of where we are. I know that somebody will say, well, Cameron, can we roll out of this and avoid the loss? No, we can't. That would be, rolling just means we're closing up one trade and realizing, in this case, the loss on the trade, and then getting a new trade and hoping the potential for profit helps to make up for the loss already incurred. So that doesn't erase loss. That just says, that's just, I was watching Barb earlier today. She says kicking the can down the road. Yeah, that's what that is. But it's still valid, though, for a trader to ask themselves, well, you know, is it a bad thing to wind up with these shares, even though I will have to overpay for them? That's the way, that's the contract deal. But if I own the shares and the stock recovers, it's still quite possible for the stock to make up for itself. And along the way, we might sell a call. This is that wheel strategy that we talked about last week. So what do you think, guys? We could go see if we can buy out of this put and just be done with it. That would be a realized loss. We could wait around and see if we get assigned. Almost certainly going to happen. And then maybe sell calls against this. We would do the former if we don't want to have anything further to do with this stock. We might choose to do the latter if we don't mind winding up with the shares and then just dealing with it afterward. I think in this case, what we're going to do is I'm going to let this go. I'm going to let us get assigned here. Now, if we're assigned at 235 and we start to implement that wheel strategy that we discussed last time, we own the shares, but remember, we're paying $235 for those. If we then went and sold a covered call at, let's say, 220, we would be entering into a contract to sell the shares for less than we paid for those. That's a consideration. If I go to the trade tab here and I look at, let's just put ourselves in our future selves' shoes and say that we wind up buying the shares at 235. We go to the 17th of April. Well, if I sell for maybe the 240 calls or even the 235, a break-even covered call, I can collect about $1 for that. 240, there's only about 58-60 cents for that. So that's one of the things that can happen when we go deeply in the money and get assigned. We have to sell at a much higher strike price just to not put ourselves in danger of being called below the price that we had to pay for the shares. So House says, why don't we roll it out? We could, but remember, rolling is not a fix. It's not a fix. That's simply saying, well, lost on this one. Let's close it up, take the loss. But if we sell a put for a future strike, a future date, that put carries with it a new premium that carries its own potential for reward, but also can start to stack on loss. If we really think the stock is going down, rolling doesn't fix anything. It can just add up one loss on another. So if we think of rolling as like an escape hatch, it's not. It doesn't fix, it doesn't repair, it doesn't save, it doesn't salvage. It just gets us out of one trade and gets us into another one. Getting out of the one when we are unprofitable means realized loss. Getting into another means we have a new premium with a new risk attached to it. Now, so we could. House Mulaparthi, I'm not saying that we couldn't. I'm not going to do that in this case. I'm going to let this one get assigned. Now, it's possible that we don't get assigned. If the stock rockets on up here and we're above 235 in 4 days, we probably won't get assigned. That's not very likely to happen. Okay, so there we go. There are the current positions. We're going to let those each work. Got 5 that are doing just fine. Got one that's, it's got some work to do. But let's get into planning a new trade. And I don't want to plan that new trade without seeing what's going on with the markets first. Looks like the S&P 500 is having another recovery day. That makes 2. Is this going to be the ultimate bottom of this pullback? Time will tell. I do think it's interesting, though, that tell me, those of you who have been paying attention to what's going on with the S&P 500 recently, what's the significance of this right here? From this all-time high on the S&P back on February 19th to this recent low on March 13th. There's something significant about the proportions of that retracement. We pulled back 10.45-ish%, just a little bit more than 10%. So that is now officially, it reached what we call correction territory. We have a label that we like to apply to things, right? A 10% pullback from a recent high on a major index is called a correction. A 20% pullback from a recent high on a major index is called a bear market. We're not in bear market territory, but we did accomplish a correction, which is fairly normal. In the general rhythm of things for the markets, we see a correction of at least 10% about every 1 to 2 years on average. Sometimes they're spread out more than that. Sometimes they happen more rapidly than that. But on average, this one came about, what is it? It's been about 18 or 20 months since the last one. So for some traders, they might just consider that to be kind of normal, as sort of panic-inducing it might be for some of the bulls out there. It never feels good, especially when you're looking at your 401k. Have you noticed that? As you get older and the 401k balance grows, it kind of stings more when we see those big dollar drops in the 401k. So it's not fun. I can empathize with you there, but it's still normal. Yeah. So for some traders, they may see this as actually just a normal in and out. Now, breathing of the markets. Does this mean that we're going to rocket up from here like we have the last two times? Maybe, maybe not. But let's just say that our trader thinks, yeah, all right, so we've had a correction. And now we've maybe course corrected from that correction. And maybe they think that things still look bullish. So they're still open to pursuing income strategies that are bullish, like covered calls and short puts. Well, let's go do a short put today. I try to give you a balance of covered calls and short puts over the weeks and the months. So we already have some covered calls. I think we have I think we're pretty balanced, aren't we? About 3 and 3, something like that. But I wanted to talk about the concept of trying to speed up the pursuit of income. And I'm going to be using Visa as our example stock today. Why did I choose Visa? Well, just as we've discussed in past presentations, there can be a number of reasons that traders might select a specific stock for selling options on in their pursuit of income. Might just be a stock that they like. Maybe they like the management. Maybe they like the fundamental apparent health of the company. Maybe they need some exposure to that company's sector, and they don't have some of that exposure yet. Maybe they consider this to be one of the leaders of that sector. But also there are considerations beyond that for those that trade options. Liquidity of the stock can be a big deal. Illiquid stocks can typically carry illiquid options. Pricing can be a problem. The price per share can be a consideration when we're about to enter into contracts to maybe buy or sell shares of the stock. But also what's happening on the chart might attract the eye of a technical trader. And let's just say that our technical trader here has looked at Visa and they see that it's been moving through a series of highs and lows. So it runs up and it pulls back, it runs up and it pulls back, and it runs up and it pulls back. And each time it does, it seems like it's been coming down to this rising area of support. It's like a ramp supporting price. So maybe they've concluded that price has pulled down and starting to rise again. Maybe it's going into its next cycle higher. And that could be good for a covered call, could be good for a short put if it keeps going in that way. John Kulak says, if you already own 100 shares and sell a call, does it become a covered call? Yep, John, it does, as long as that call is sold in the same account where the shares are held. Yep, it does. Yeah, now you'd have to be careful as well. If you have a stop order on those shares and the stop order is triggered, shares are sold, we still have the short call, that could make it an uncovered or a naked call. Yep, but yeah, that's a covered call. And you don't have to designate it. By the way, when you're placing that order to sell the call, you don't have to tell the system in any way, this is a covered call. It's intended to be paired up with those shares I already own. Nope, we just sell it in the same account where the shares are held, and it's covered. All right, but let's look at maybe selling a put. Now, for some traders, they've noted that when selling options, there's this thing called time decay that can really work to the advantage of the trader. There are elements of trading that they're hard to predict. I think it was it Yogi Berra that said it's tough to make predictions, especially about the future. That's a great quote. Well, one of the predictions that I can make with a high degree of certainty is that time is going to pass. Yep. Whether I'm here to witness it or not, time is going to go by, and time works in the favor of out-of-the-money short options. But there's an interesting fact to the passage of time. Even though time is linear, the impact of time decay on options is not linear. It actually speeds up the closer we get to expiration. And that time decay element may be what our income-oriented investor is really trying to optimize. So let me show you what I'm talking about here. Let's do a quick comparison. Let's say that we have a trader who's trying to speed up the income realization on their options that they're selling. So I'm going to go to the trade tab here, and I'm going to compare two example trades. Let's open up our scratch pad, and we have example trade A, which is going to be a short-term short put. That's kind of sounds redundant, but it's not. An example trade B is going to be a longer, not truly long-term, but longer-term short put. And the objective here is we're trying to speed up the accomplishment of income. So we're going to compare the 21st of March and maybe the 17th of April contracts, sticking with these typically more liquid monthly expirations. So let's go to the 21st of March, expiring in just 4 days. And I said this webcast is going to be about selling put options for income in less than 10 days. Yeah, 4 days. That meets that requirement. Well, actually, let's go out here to the 17th of April first. Let's do this one first for point of comparison. And with our stock recently bouncing off the trend line here, right at about 325, how about we look at selling? So you can see we're sort of intersecting with that right about here. That's about 325. Can you see that if I pull that out here, halfway between 330 and 320? Well, if I go to the trade tab and I go to the 17th of April and look at selling a 325 put, that looks like it's trading between 425 and 440. Sell the 17th of April 325 put, and let's say we're able to get 430 for that put. Okay. Now let's compare that to the 21st of March. And we're going to stick with the same strike to make it a fair comparison. Let's sell the 21st of March. The 21st of March, 325 put. Now look at this. Did we just take a big step backward? Instead of making 80, instead of making maybe 430, not making, but collecting, we're only collecting about 85 cents. Why in the world would somebody choose a much smaller premium versus a much larger premium? Well, let's weigh the pros and the cons. And yeah, I am going to be giving greater emphasis to this decision because there are potential pros to selling for shorter time frames. What is the driver of selling very short-term options? Well, it's because time decay tends to accelerate as we get closer to expiration. So a primary reason why some traders will choose to sell something as short-term as like a 4-day contract, maybe even shorter, is theta, time decay. Look at that 325 put. If we sell this for 85 cents right now and the stock goes nowhere, let's just assume the stock does nothing. Let's assume volatility doesn't move. So we have three big drivers of the pricing of options: volatility, price movement, and time decay. Let's just talk about time for a moment. Let's assume the stock does nothing. BISA doesn't go anywhere over the next 24 hours. 24 hours from now, our 85-cent put that we collected has lost 29 cents of that value. That is a huge reduction in that premium. 29 divided by 85 is a 34% move toward the maximum gain on this trade, and all it took was the passage of 24 hours. Now, if we compare that to the 17th of April, look at that 325 put, it has an 11-cent theta. So 24 hours go by, this $4.30 contract is now worth $4.19. Let's do the math on that. 11 divided by 430 means that 2.5%. We've closed the gap toward maximum theoretical gain by 2.5%. That time decay is massively different in a shorter term time frame. Time is really working in the favor as long as the contract remains out of the money, and that can be a major attraction. For some traders, they actually look at this theta as their quote-unquote income for the day. And if we are entering into one contract where someone has the right to sell us shares for $325, versus a second contract where someone has the right to sell the shares for $325. And one is set to make $29 over the next 24 hours, and the other one's set to make $11 over the next 24 hours. Ooh, you can see why that could be attractive. Nearly 3 times the potential income from the same behavior, just the passage of time. So that is pro number one. Now, before we get too excited, there are definitely going to be cons to this, but the day-to-day potential for income on the shorter term contracts is certainly higher. Okay? Now, what other potential benefits might there be to taking these short-term contracts? Well, let me just ask this question. Let's lean on our feelings a little bit. Does it feel better to be in a contract where somebody can have the right to sell us shares for $325 at any time for the next 31 days? Or does it feel better to be in a contract with someone else where they have the right to sell us shares for $325 for just 4 days? The other shorter term contracts are giving the stock less time to misbehave in a major way. There's conceptually less downside risk. Now, in reality, the downside risk is the stock could collapse to zero. It's just less likely to do it in 4 days than in 31 days. Does that make sense? Doug, you like this analysis? Okay. Yeah, so if we're getting ourselves into contracts, we have to be able to understand the pros. Now, unfortunately, what typically happens is when somebody's talking about a new strategy or a new approach to a new strategy, is they only talk about the pros and they make it look like this is the way to do it, because that's what sells books, that's what sells videos, whatever. We don't do that when we're trying to learn. I'm an educator, so my role is to make sure that it's a balanced discussion, so we're making informed decisions to the extent possible, right? All right, so a larger day-to-day potential reward, also less time for the stock to do something unexpected, and there's just a quicker realization of gains as long as the stock cooperates. We just don't have to sit around for nearly as long to get the answer to the question. Is this going to work or is it not? 4 days on the one contract, 31 days on the other contract. So those are kind of the fun side of the equation. Now, Eva's raised a great question, a great observation, because I want to make another follow-up video. I don't know if I'll do it next week or just in the coming weeks, but I want to talk about the motivations of selling options way out in time. It almost sounds like it doesn't make any sense. Actually, it can make perfect sense depending on how the trade plays out. Yeah. So Eva, I want to have a discussion about selling long-term equity anticipation securities, LEAPS contracts for income, even though the time decay is so slow. Guess what? Might not matter. So, yep, let's put that one on the docket for an upcoming webcast. But let's hit the cons for a moment. I'm gonna place this trade just to break it up a little bit. Let's go ahead and say we're gonna do this 21st of March, 325. Let's sell a put. We could sell multiple puts. We just have to be aware that we're getting into ourselves into an obligation to maybe buy 100 shares, maybe buy 200 shares, maybe buy 300 shares. But let's do this 325 put. I'm going to sell that. Click on that. Let's hide that left column for just a moment. Let's just do one contract for this example. Looks like our natural's around 83 cents. The mid, if we're able to get a fairly favorable fill, might be 85 cents. I'm going to say we're going to settle for 83 cents. Okay, let's click confirm and send. That's our limit. Still might not fill even for 83 cents. Got to subtract commission from that. So if we're able to fill, that would leave us with $82.35. But let's send that order off. Okay, we sold it for 89 cents. All right, great. Awesome. Anyways, I'm going to update this just a little bit. And since I bumped that up 5 cents, let's say we were able to get 5 more cents out of this. I know that was 4 cents. I'm just rounding. Anyway, let's talk about the cons. The first one is obvious. It's a smaller premium. Yep. 89 cents versus $4.35. On a day-to-day basis, this is still a larger amount. Even if we just we've looked only at time decay, but if we were to just chop that on a day-to-day basis, 89 cents divided by 4 days is basically 22 cents per day, whereas 435 divided by 31 is 14 cents per day, or $14. So there is a smaller premium that can be collected, but a larger day-to-day potential for reward. Okay, smaller premium is con number one. Number two is if our trader out here in April didn't need as much as 435, maybe they'd say, I'd be willing to settle for a lower premium. I just don't want to be so darn close. Look at where we're talking about selling that premium. Here's our put, theoretically. The stock's only right there, so it wouldn't take many days to get down below that strike price. What if they wanted to back off a little bit, maybe considering selling the 320 put? Well, to our trader out there with multiple days on their contract, they might still be able to collect a reasonably sizable premium, still $315 to $325. Whereas with 4 days left, those premiums start to dry up really quickly. Look at this, 45 cents, 28 cents, 18 cents, and we've only moved, in the grand scheme of things, we're not moving that far away from the current price of the stock. It's just that when we go very close to expiration, there just isn't much chance that the stock has enough time to get down to these levels. And so therefore the buyers aren't going to be willing to pay the price. Yeah. So a second potential con of selling these short-term contracts is that we have to push our strike price that we choose closer to expiration to quote unquote make it worthwhile. Ilan Chayan says selling the put in the money, theta hurts the seller. It can. It really depends on whether the trader is looking for assignment or not. But yeah, the likelihood of assignment is higher. Yep. You still get time decay. That's still a possibility, but assignment risk is higher straight out of the gates. Okay. Anyway, smaller premiums. We've got to push closer to at the money just to be able to get a premium that the trader might seem to find as adequate. When we go closer to at the money, what does that do to assignment risk? It goes up. Yeah, even if we're out of the money, those contracts that are closer to at the money have higher assignment risk. So if we're really trying to avoid assignment, that is actually being dialed up. It's going the opposite direction for those traders that have those concerns. And if the stock makes a little move, blip, that can put the contract in the money, dialing up that assignment risk even further. And we're already close to expiration, which is one of the contributing factors to higher assignment risk. So, recapping again, smaller premiums, got to sell closer to at the money, higher assignment risk. Now, we discussed how having a short amount of time gives the stock less time to misbehave. That's true. At the same time, it also gives it less time to recover if it does misbehave. Let's go to our charts and try to visualize this for just a moment. Stock's up here. Let's assume, let me remove this drawing down at 320. Let's assume that we sell, and actually I'm going to have to activate this drawing. I'm going to have to zoom in here. There we are. And let's activate this drawing and assume that we let it expire. Here we're going to go for the March 21st expiration. So there's our contract right down there. What if the stock tomorrow gets some bad news and it drops? We're already close to expiration. Now we're in the money. Assignment risk has just gone up. And there's not much time left for that to reverse course. Yeah. So there is that we have to be aware of, that we've got to keep a close eye on things, because if the stock goes the wrong direction, there's not a lot of time to recover. So this is a trade that can also require closer oversight especially if we're trying to avoid assignment. Okay. Now, finally, there are more commissions generated. If we're doing contracts every 4 days versus doing contracts every 31 days, we're doing way more trading and there are more commissions being paid. That's not as much of a consideration as maybe it once was back in the day when commissions were larger, but it's still a consideration. All right. So there are definitely pros, there are definitely cons to this. Now, we've placed our trade, but I do want to talk about maybe a couple of other considerations here. So in preparing for this, I had what I labeled pros for this strategy. I had what I labeled cons for this strategy. And then I might just say there are other potential considerations. Number one is earnings. Earnings can, if we sell a short-term contract over an earnings announcement, that can actually boost the premium, which can be good. But it can also introduce a highly volatile event. And if the stock drops hard, we have a contractual right to buy it at a prescribed price. If the stock falls hard, that can really increase the risk of the strategy. So for some traders, maybe they prefer to sidestep that. Not everybody does, though. So it's kind of in the category of what I would consider or label a consideration. Number two is liquidity. Yep. When we get close to expiration, there can tend to be a widening of the spread between the bid and the ask prices. So having the most liquid stocks can be even more important to try to close up that spread distance as much as possible. So maybe an even greater emphasis on liquidity. Oversight of the trade is another consideration. We talked about that. The precision of timing. If we have to be really close to where the stock is with the strike price that we're selecting, and we know that a couple of days in the wrong direction can put us into a higher probability of assignment, not much time for recovery, precise timing can be another consideration. So maybe the trader might want to brush up on their technical analysis if they think that might boost the probabilities for their trading. But in any case, there we go. We've accomplished what I set out to do today. Yeah, guys, selling shorter term contracts can deliver higher income potential on a day-to-day basis, but it comes with its own set of potential cons as well, and also other considerations for the trader. So I hope this has been helpful for you. Eva, yeah, I think we need to talk about the longer term end of things in a future webcast. So I'm going to put that on the list maybe in the next week, 2-3 weeks, something like that. But everybody, thanks for giving me your time today. We'll see how this trade goes in the coming weeks. We'll follow up on it just like we are on our other positions. But time for me to let you go. Before you go, though, do yourselves a favor. And number one, make sure that you're subscribed to our Trader Talks channel if you haven't done that yet. Go down and click on the subscribe button. It only takes a second. You can find it right down below the video stream right now. And it doesn't cost anything, but our Trader Talks channel on YouTube is where we house our previous webcasts. So you can find our playlist for series like this one. And you can join our live streams right here as well. Now, another thing that I would definitely recommend you do is follow Barb and me on X. If you're not doing that already, if you have an X account, if you have an account with X, give Barb a follow at Barb Armstrong CS. You can follow me at Cameron May CS. But this is where you can get observations about the markets in between. Also, sorry about that. I just noticed a little bit of a technical issue. Okay. All right, but thanks everybody for the like. That's always appreciated. It sounds like applause to your presenter. It also gives a boost to the presenter's webcast on YouTube in the YouTube algorithm. I will see you in a future webcast. I'll see you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.